Accounting for Your Business, Chapter 1, Making Informed Decisions. Starting a new business is a daunting task for anyone. There's not just the worry and stress of setting up the business, finding a location, worrying about success. Accounting for a small business is probably something in which most people starting a business have little or no experience at all. Setting up a financial system that works for your business is as important as deciding to open your own business, because regardless of what you do or what you sell, it all comes down to numbers. For example, how much money comes in, how much money goes out, and what is left. We start with the basic concepts and comparisons of bookkeeping versus accounting. From there, we need to determine how often the business wants to report its financial transactions. Will the business be cash sales only, or will it sell and purchase on credit? These are needed to determine whether its financial records will be maintained using a cash basis or an accrual basis counting system. What type of records will the company keep? And what control and/or restrictions will the owners put in place? These are the company's internal controls or critical procedures that are put in place to protect a company's assets and provide reliable financial and accounting records. Exactly how does accounting differentiate from bookkeeping? Bookkeeping is the methodical way in which a business tracks its financial transactions, and accounting is the total structure of records and procedures used to record, classify, and report information about a business's financial transactions. Reporting in accounting assumes four concepts. First, the accounting period assumption is the concept that a business's income is reported in regular time intervals. Second, an accounting period is the time in which a business tracks its financial results, for example, monthly, quarterly, and annually. Third, a fiscal year is the company's 12-month financial reporting period. And finally, an annual report is the year-end summary covering a company's activities and financial results for a 12-month period. There are two types of accounting that are used to record financial transactions. The first is the accrual basis accounting. And when using accrual basis, cash isn't the primary focus in recording transactions. They're recorded at the time the services or the goods are sold. So for example, Company A sells goods to customers and they allow the customers to borrow on credit for those goods and pay at a later date. Another example, the same company, they purchase their goods to sell to their customers, but they don't have to pay their supplier until a later date. In this type of accounting, the expenses are recorded as they're incurred. So if I have an expense that I incur today, but I don't have to pay for it for a month from now, I still record it as an expense in this particular time period. As I mentioned, the focus is not on receiving cash or paying cash. And there are requirements for certain companies to use this accrual basis accounting. One is merchandising companies, and the second are publicly traded companies. Let's take a look at cash basis accounting. In cash basis accounting, the financial transactions are only recorded when cash changes hands. Under this concept, cash can be defined as actual cash, checks, point-of-sale debit cards, and credit card sales. This does not include credit extended to its customers, but actual credit cards themselves. In the cash basis of accounting, expenses are recorded when they are paid, not when they happen. So if I have my rent that is due on the 1st of next month, but I go ahead and I pay that rent on the 20th of this month, I record that rent expense on the day that I actually pay the expense. Cash basis is typically limited to smaller service type businesses. And the other area that you really want to get a grip on is internal controls, which are procedures that are in place to protect a company's asset and provide their reliable financial records. We actually go into more detail in Chapter 7 about protecting financial records and controlling cash with internal controls in place. Every business makes money essentially in one of three ways. Its type of operation is a service business, a merchandising business, or a manufacturing business. A service business does not have inventory, raw materials, or material goods to sell. It sells services like accounting, legal, medical, even a dog walking business. It makes money by doing something, not selling something. A merchandising business buys the things it sells. It carries an inventory and sells the goods and products it buys from suppliers. A newspaper stand is a merchandising business. So is a clothing store, a grocery store, or a large store like Walmart. Gas stations are another example of a merchandising business. A manufacturing business sells goods that it produces from raw materials. It basically buys all the parts, materials, or ingredients and makes a finished product and sells it, usually to a merchandising business. Automakers like Ford or General Motors are manufacturers. They make cars from material they purchase. Likewise, a bakery shop is a manufacturer. It buys ingredients and sells finished products like breads, cakes, and pastries. The form of a business's legal structure does not just identify how it is organized and how it is owned. It also may limit the owner's personal and tax liability. Essentially, there are four basic types of legal structures for businesses: sole proprietorships, partnerships, corporations, and limited liability companies. A sole proprietorship is a business that is owned by one person and for legal and tax purposes is not separate from its owner. A partnership is a business owned by more than one person and similar to a sole proprietorship is not separate from its owners for legal purposes. If a company may face the possibility or risk of being sued, the safest structure is a corporation, a separate legal entity that protects its owner's personal assets against claims against the business. The fourth business structure is a limited liability company or an LLC, which is a structure that provides its owners with some protection from being held personally liable for the business's activities. Limited liability companies are becoming more and more popular, and they do offer that protection for a sole proprietor or a partnership. To further identify business structures, partnerships can either be general partnerships or limited partnerships, as well as limited liability companies. In a general partnership, the partners run the day-to-day business and have unlimited legal liability. A limited partnership may have one or more general partners and one or more limited partners. The general partners have the same responsibilities and liability as in a general partnership. However, the limited partners are passive owners and their liability is limited to the amount of their investment. In the same light, corporations have two structures, C corporations and S corporations. And while the legal limits are similar for both, each of them has its own unique tax requirements and practices. My personal favorite of all of these structures is the S corporation. Most small businesses used to keep their financial records in paper form. The cost and expertise needed to acquire, install, and maintain computerized systems were just too restrictive for small businesses. Today, in the age of technology and instant information, the vast majority of businesses, both large and small, use computerized systems. There are not only very reasonable priced systems out there, but in most cases they're very easy to use, even for a one-person sole proprietorship. They also minimize the chance of errors, increase overall bookkeeping accuracy, and saves the company valuable time. The most popular accounting software that's used today is QuickBooks. Setting up a computerized accounting system is normally just following the instructions in the tutorial that comes with the program. You can also find a lot of videos on YouTube that go into more detail on how to use various aspects and templates within the program. To begin, you'll need to develop a chart of accounts, which we discuss in Chapter 2. Select an accounting period, monthly, quarterly, annually. Typically monthly is the most commonly one used. And then you determine your fiscal year, which is normally a calendar year. Other matters to consider are the accounting system to be used, whether it's cash or accrual, the legal structure, and the type of business operation. The latter is needed if you need to collect sales taxes on sales.